Good morning, students. Today we will be doing chapter 10, which will be the last chapter for this course. If you recall, we have covered chapter 1, the finance decision, chapter 2, capital markets, market efficiency and ratio analysis, chapter 3, short-term finance and working capital management, chapter 4, long-term finance, equity finance, chapter 5, long-term finance, debt finance, hybrid finance and leasing, chapter 6, an overview of investment appraisal methods, chapter 7, investment appraisal, applications and risks, chapter 8, portfolio theory and capital asset pricing model, chapter 9, the cost of capital and capital structure, and chapter 10, dividend policy. This will be the last chapter for this course. So your focus for the final exam should be on the 10 chapters. Chapter 11, mergers and takeovers, and chapter 12, risk management, is to be ignored. To begin with, on chapter 10, I will have the series into 3 separate videos, starting with the introduction. As you know, as I previously mentioned, corporate finance involves 3 areas of decision making, i.e., the investment decision, where investment projects are evaluated and suitable projects selected. We have learned this using the payback method, the ARR method, the NPV method, and the IRR method. In particular, pay more attention to the NPV method. And the finance decision, where finance is raised to enable selected projects to be implemented. Here, we covered it under the cost of capital to determine what sort of sources of finance are to be used to finance a particular project. Last but not least, the dividend decision, which consists of the amount of earnings to be retained by the company and the amount to be distributed to shareholders. All 3 decisions are closely linked with one another. You cannot have one decision without another being made. If you scroll down the slides, the decision to pay dividends versus retain earnings to reinvest in the firm. This is the decision that finance managers must make. If you pay too little dividends, shareholders will be unhappy. And if you pay too much dividends, there will be very little retained earnings to be reinvested in the firm. As you know, a dividend decision is a cash payment made on a quarterly or a semi-annual basis or an annual basis by a company to its shareholders. There basically are 2 types of dividend. First, the interim dividend, which will be paid midway through the financial year, normally 6 months after the year. And the final dividend, normally paid after the financial year is over. The interim dividend does not require shareholder approval, whereas the final dividend requires shareholder approval. In the next slide, dividends and earnings. Before I move on to that, I want to highlight this point here. A company with few suitable projects should return unused earnings to shareholders via increased dividend. A company with several suitable projects that maintains a high dividend policy will have to find finance from external sources. Take for instance Toto. Toto has got very good profits, and because they have very few projects in mind, Toto returns unused earnings to shareholders through an increased dividends. Moving on, the dividend decision is closely linked with the financing decision of the company. The dividend decision must take into account the views of and expectation of shareholders. For instance, take my note here. Managers need to take into account views and expectations of shareholders. Attitude of shareholders to changes in the level of dividend paid must be balanced against availability and costs of internal and external sources of finance. When I talk about the costs of internal and external sources of finance, internal sources of finance would mean retained earnings. External sources of finance would mean selling shares and selling bonds, along with bank borrowings. Retained earnings are preferred as a source of investment funds. I mentioned the word here, the pecking order theory. If you refer to page 308 until 310, there's a section that explains to you what the pecking order theory is. Similarly, if you look at this side of the slide, I've given you an explanation of what pecking order theory is. It suggests that companies, rather than seek optimal capital structure, prefer retained earnings to external funds and prefer new debt to new equity. So basically, it means that companies should use retained earnings first before they move outside of the company to source for funds. When they seek funds outside of the company, they prefer to borrow money rather than to sell shares to raise funds. I want you to pay attention to this word, asymmetric information. Asymmetric information basically is explained by having this explanation. All right? So pay attention to this word. Moving on, we now look at the operational issues of dividends. Dividends must be a distribution of after-tax profit made on a cash basis. Two types of dividend, as I mentioned before, interim and final dividend. Together, combined, they make up total dividend for the year. Shareholders must approve the final dividend. Take note of these 2 points in the slide. When dividends is announced, the share price goes cum dividend, meaning the buyer of the share also buys the rights to receive the next dividend. However, when the share price goes ex dividend, the buyer no longer gains the right to receive the next dividend. It is again highlighted in the next slide. Here, this is cum dividend, meaning to say if the buyer buys the share of the company, he will be entitled to receiving dividends. But once the share price goes ex dividends, he will not be entitled to the dividends. This is an investment strategy for you all. In the next slide, you will notice a graph. Whenever the company declares dividends, you will notice a drop in the share price. You can see it in this highlighted portion here. You can see it in the highlight portion here, as well as here, and as well as here. The drop in the share price will reflect the amount of dividends to be paid. For instance, if the company's share price is $2 and the company declares a 20-cent dividend, the share price will drop to $1.80, reflecting the difference between the share price and the dividend to be paid. Ultimately, once the dividend has been paid, if the company is a financially solid company, the share price will move along and go up to a higher level. We then move on to practical issues on paying dividends. What stops a company from paying a higher dividend? I extended this thing here, practical issues to be considered when paying dividend. The first thing we have to consider are legal constraints. Legal constraints means that dividends can only be paid from accumulated net realized profits. Because of regulations such as accounting standards, it restricts the amount of dividends to be paid. Similarly, governments may impose restrictions on the amount of dividends a company can pay. This is because of tax purposes. Additionally, there could be restrictions imposed on dividend payments by loan agreements or covenants. Covenants we have covered in chapter 5 under bonds. These restrictions may be imposed to protect the interests of companies' bondholders. Not necessarily only bondholders, it could also mean banks. Similarly, you will notice practical issues. Number 2, liquidity. Because dividends are cash payments, managers will need to consider the effect on liquidity of proposed dividend payments. As you know, each company that declares dividends will have to fork out a large amount of money to fulfill dividend payments. It might eat up into the cash flow of the company, thereby rendering the company not cash rich. You should know that higher levels of profits may not mean large dividends, as profit is not the same as cash. Additionally, there has to be interest payment obligations. This was mentioned earlier, whereby if the company's borrowings are very high, the interest payments have to be fulfilled first before dividends can be paid. So you will notice this one, which I have highlighted. Funds available for dividend payments will be reduced if the gearing is at a very high level. Therefore, finance managers need to consider all these practical obligations, all these practical issues before deciding on the amount of dividends to be paid. I also explain in this particular point here, which states that constraints on dividend policy. A highly geared company with high interest payments will have lower profits from which to pay dividends. The last practical issue is the amount of investment opportunities open to the company. If the company is faced with a large number of attractive projects, the company will be pressured to reduce dividends in order to finance new projects from retained earnings. Notice this is from the pecking order theory. Unfortunately, in this case, shareholders, when dividends are reduced, shareholders will not be happy, and hence they will leave the company by selling their shares and moving on to another company. This is what the company cannot afford, as if there are more sellers selling their shares, the share price will drop. We have now come to the end of session 1, whereby we covered the basics, the underlying foundation on dividends, and the practical issues. In the next session, we will carry on with session 2, whereby we talk about dividend irrelevance. In session 3, we will cover dividend relevance. Thank you.